Hey guys, hope everybody's doing well today. Today we are going to go over the poor man's covered call with the Pfizer position that I have. I've been liking this position, and this is a good example because the past couple I've shared, I've closed out, right? I've closed out for profit, and this one is kind of the opposite. And I wanted to share with you what happens and what it looks like when you buy a leap and you start selling calls and that stock starts going down. We already know when the stock goes up, if you get called out of your short calls, your shorts, your leaps usually end up in profit. So you can close out both ends and end up in a profit, correct? So I wanted to go over Pfizer because this is one I bought in, and this is what happens when the stock dropped. So if you're new here, I'm pretty much new to poor man's covered calls, so this is an experiment on my own. I'm no expert. I'm kind of the guinea pig of this thing and just sharing with you what my experience have been with them, and for the most part, most of them I've closed out early. But I've always pictured the poor man's covered call as a long-term income play, right? And this is kind of how this Pfizer one is playing out, and I'll go over it as and try to explain it as best I can. These options things are hard to discuss and try to explain cleanly. I know that's hard to understand, but if you're in these things, you understand it. So I'll try to walk you through the whole Pfizer thing from beginning to end. I don't have I kind of do have exact dates. So let's just start and we'll follow it along here. So this is the Pfizer. I'm still in the poor man's covered call tracker 1.0. I haven't switched over to 2.0 just yet. But on January 25th, I entered a position in Pfizer and I bought a leap with the strike price of $25. Now I know this says 3 contracts, but at the time I only bought one, and the price of the stock was trading at $37.39. And that same day, I sold a covered call with an expiration of 2/19 with a 37.50 strike, which was just right out of the money, and I collected 88 cents for that. And what I ended up doing was I want to say February 3rd, I closed that position at 18 cents, and I realized a total profit of $68.03 from that short position, that one. Well, before I closed this one out, I had bought another leap to average down because, as you can see, the price of the stock trended down. So on January 28th, I bought another leap, but I don't remember. I should have put those prices up there, but I bought another leap to average down. And I sold another short call of $37, collected 87 cents. And on February 3rd, I closed that one out for 22 cents for a total profit of $62.91. I hope you're following this here. I know this is hard to, like I said, it's hard to explain. So with those two closed out, I went ahead on February 3rd and opened up 2 more covered calls against the 2 leaps that I had. Expiration of March 5th with a strike of $36. I collected 57 cents on each of those. Now on that day, I also bought another leap to average down because the stock price kept falling. So now I own 3 leaps, but I've only sold 2 contracts against it. Now, the next day, the stock dropped again to $34.50, And what I did was I was able to close out those short calls that I sold just the day before for a total profit of about $59. And I ended up with now 3 leap contracts. So on February 4th, I sold another set, all 3 short contracts, covered calls with an expiration date of 3/19, with a strike price of $35, and I collected 80 cents each from each of those. Now, with all of that, from January 25th to February 4th, I collected a total of $426.82 in covered call premiums. Now, with the price going down of the stock, the leaps are also reducing they're going down in value. So if you look here, the current price of a leap, you can buy one right now that I'm in for $10.10. So I'm actually down $405 in leaps as it sits, but I've collected $426.82 in covered call premium. So the hope is for me, you might look at this and say, oh, cash on cash, 0.64%. But I think this is ideal. Okay. What I would like to happen is before March 19th, that Pfizer stays below $35. And then I'll just be able to repeat this all over again. Sell another 3 contracts at 80 cents a piece and just keep collecting $240 a month, roughly, until, for a year, or more, but that's with Pfizer staying under $35. If it were to stay between, the price it is now and $35 for a whole year, I can just continue collecting this money. This is like collecting a dividend off of 300 shares every month instead of every 3 months, right? So this is what happens when the stock has a slight decrease from when you bought it. You end up making money in covered calls, but your leap profits may be going down. You would have to consider either averaging down in the leaps, which I did. So my leap average cost right now is $11.45. And I'm looking to possibly, if I don't want to get too heavy, but I could add another leap and bring my leap premiums down a little bit more and up my income every month. So, to collect this much money, that's what happens when the stock falls. You collect more money in covered calls, but you lose money in the leap profits. But as long as the stock doesn't fall dramatically, you can just keep following it down and collecting premium on the way down. I hope that makes sense. Now, the detrimental part of a poor man's covered call were to be if Pfizer were to, put out earnings or some bad news of some kind of medicine that they produce had a bad reaction and this stock fell to $20. If that were to happen, you are pretty much screwed. Let's just put it that way. You're screwed because you cannot sell if you cannot sell you're above your, how am I trying to say this? See, I told you this was hard to explain, but your short strike break even price right here is still going to be $28. So if Pfizer dropped to 20, there's no covered call that you can collect premium from. So this is essentially would be a dead position. And, you have your leaps, you hold on to your leaps, you have 2 years roughly for them to recover. and hopefully they'll recover enough to where you can start collecting premium again. But that's worst case scenario in a poor man's covered call, is you get into the stock and it crashes. Okay, now if you get into the stock and it goes down, slowly over time, like Pfizer did, that's okay, because you can follow it down, you can average down, you can buy back your short calls for profits like I did here, and you can sell new ones and collect more money. So I hope this makes sense. Like I said, these are very difficult videos to actually make and to actually talk through, because it's difficult to put this across and put it across as in a way that anybody can understand. So I hope I helped somebody out there that understood what I was trying to come across, and if not, please leave me a comment down below. This might be the last of the series, unless you got more questions on poor man's covered calls. Otherwise, I might possibly continue doing updates on this, and we'll just follow it along. Maybe I'll do weekly or monthly updates as I make changes. You let me know down in the comment section below, and you guys have a great day, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.